Lab-made gold is an emerging technology that few people are aware of, yet it has the potential to reshape the physical gold and silver market in the coming decades. Scientists are developing methods to create synthetic gold and synthetic silver using processes like vapor deposition and electrochemical synthesis, producing metals that are chemically identical to their naturally mined counterparts. Unlike traditional mining, which requires extensive environmental disruption, lab-made gold and silver could offer sustainable and efficient alternatives. However, despite their scientific viability, mass production remains at least 10 to 15 years away, as researchers refine techniques to scale production while maintaining cost-effectiveness. Please consider subscribing to our channel and clicking the thumbs up icon. The ability to distinguish lab-made gold and silver from mined metals is crucial for pricing and investment markets. Advanced detection methods, including spectroscopy, isotopic analysis, and trace element differentiation, can reveal subtle structural differences, allowing buyers to verify authenticity. While lab-made gold and silver could lower overall prices by reducing scarcity-driven fluctuations, investor sentiment and the historical status of these metals as stores of value may prevent full acceptance. This uncertainty mirrors the early skepticism surrounding lab-grown diamonds, which, like physical gold and silver, have since gained significant traction in the jewelry industry.
Although lab-grown diamonds lack the resale prestige of natural diamonds due to perceived rarity differences, their quality and affordability have made them a popular choice.
While cubic zirconia is easily identified through optical and spectral analysis, lab-grown diamonds require sophisticated methods, such as microscopic laser inscription and spectroscopy, for authentication. This reinforces the idea that market value is heavily influenced by perceptions of authenticity and rarity across precious materials. Although silver is often manipulated in the market, it is grossly undervalued given its extensive industrial applications in electronics, solar energy, and medicine, and its potential price could explode once manipulation fades. Because of silver's physical storage challenges, holding accessible physical silver in addition to gold is crucial. As the digital age progresses, the roles of gold and silver are evolving. Historically, these precious metals have been seen as safe havens in times of economic uncertainty. However, the rise of digital currencies like Bitcoin is challenging their traditional dominance. While Bitcoin's volatility compared to physical gold and silver has reached a historic low, making it behave more like a stable asset, this shift is attracting institutional investors who previously relied on gold and silver for portfolio security. Additionally, Bitcoin's scarcity is fixed at 21 million coins, unlike gold and silver, which can still be mined or even synthesized. This programmed scarcity, along with Bitcoin's superior growth rate, makes it an appealing alternative to traditional inflation hedges. Gold and silver prices tend to react to Bitcoin's movements, particularly during major price swings. When Bitcoin crashes, both gold and silver often see increased demand as investors seek stability. However, as Bitcoin gains mainstream acceptance, its role as a hedge against inflation could diminish the dominance of physical gold and silver, leading to price stagnation or even depreciation if Bitcoin continues its upward trajectory. Asteroid mining has the potential to flood the market with mined gold and silver, drastically altering their scarcity and value. Some asteroids, like 16 Psyche, are estimated to contain $700 quintillion worth of gold and significant quantities of silver, enough to make every person on Earth a billionaire. If large-scale asteroid mining becomes viable, the scarcity-driven values of both metals could collapse, leading to a price drop of over 90%. While asteroid mining is theoretically possible, it remains decades away due to extreme costs and technological challenges. Companies such as Planetary Resources and Deep Space Industries have explored asteroid mining, but financial hurdles continue to stall progress. NASA's Psyche mission, set to launch in 2026, will study the asteroid's composition. However, actual mining operations could take 30-50 years to become commercially viable. If asteroid-derived gold and silver enter the market, the supply-demand balance would shift dramatically. the prices of these metals could plummet by 90% or more, similar to how synthetic diamonds disrupted the natural diamond industry. Countries reliant on gold and silver mining could then face economic instability, while investors may shift toward Bitcoin and other scarce assets. The drastic reduction in gold and silver prices due to asteroid mining could create a paradox. If these metals become abundant and their values drop by 90% or more, the economic incentive to extract them from space diminishes. Mining an asteroid like 16 Psyche could cost billions of dollars, and if the expected return on investment collapses, companies may abandon the endeavor altogether. However, asteroid mining isn't solely about gold and silver. Many asteroids contain rare earth elements, platinum group metals, and water, resources critical for space exploration, electronics, and sustainable energy. Should asteroid mining become financially viable for these materials, extraction of gold and silver might still occur as byproducts, even if their individual values plummet. Beyond their roles in financial markets, physical gold and silver have historically proven invaluable following disasters. During major crises, such as the 2008 financial collapse or previous economic depressions, gold and silver prices have surged dramatically. Moreover, while banks and stock market ETFs might lock away your assets during a crisis, physical gold and silver must remain accessible. It's essential not to store all your gold and silver in a single bank safety deposit box, as banks can close during disasters and trap your assets. To mitigate this risk, you should store your gold and silver in multiple safety deposit boxes across different banks and in other secure offline locations. As we move deeper into the digital age, the interplay between traditional and digital assets will continue to shape financial markets. Investors must stay informed and adapt their strategies to navigate this evolving landscape. JP Morgan predicts that Bitcoin could outperform gold by late 2025, driven by corporate investments and favorable regulations. Some U.S. states are even adopting Bitcoin-friendly reserve policies, reinforcing its legitimacy as a financial asset. Thank you for watching, and please subscribe.